Welcome back. You're tuned into Inside Out here on CNBC-TV18. Well, as promised, there's another stock on our radar. Sonal, introduce the stock to us. Tell us, what are you focusing on in our Swotlight segment?
Okay, so Nigel, I'm going to be talking about Chemplast Sanmar. As I told you earlier, that this has been a stock which has been buzzing off late. In fact, it saw a lot of traction in the month of December. The stock, though, has not given much returns since the time of listing. In fact, it listed at a discount of 3% to its issue price, and the stock price is actually currently below its listing price of 550 rupees per share as well. So the underperformance continues. The company is a leading manufacturer of PVC paste resin and is also backward integrated for chlorine, ethylene dichloride and vinyl chloride monomer, and this gives exposure to caustic soda, chloromethane and hydrogen peroxide markets as well. So yes, backward integrated is something which is a positive here.
Well, Sonal, so there are a lot of products that you spoke about. Give us a breakup. How much does each product contribute? And also, which industries are they catering to?
Okay, so there are three segments and a lot of products. So let me break it down for you. Each of them have number of products. So the first segment is specialty chemicals, which is 21% of the revenues. And this has two more segments. Specialty paste PVC resin, which caters to footwear. There's auto upholstery, there's leather and mats as well, with a capacity of 66,000 tons per annum. Then there is custom manufacturing, which caters to pharma, agrochemicals, API molecules, chemicals, and has a capacity of 1,068 tons per annum. Then there is other chemicals, where they manufacture caustic soda, which is catering to paper, textile, chemicals with a capacity of 1,19,000 tons per annum, hydrogen peroxide, which caters to paper, pulp, textiles and has a capacity of 35,000 tons here. And lastly, third and the biggest segment, which is suspension PVC, which is used in infra, real estate, irrigation, and this is 66% of the revenues of the company. The biggest capacity here as well, more than 3 lakh tons per annum. Now, as per the company, it is the #1 manufacturer of specialty paste PVC resin in India, #4 of caustic soda in South India, #1 in terms of suspension PVC in South India, and second largest in India as well. It is also the #1 manufacturer of hydrogen peroxide in South India.
Okay, got that. How does all of this look at in terms of revenues as well as margins? And you said the stock has underperformed. Something to do with the financials?
Yes, it could be the reason why we have been seeing this underperformance, because revenues, they've continued to see an increase till FY22, and come FY23, the cycle saw a decline, and hence first half was not as motivating in terms of revenues. They came in at around 1,139 crore rupees. So commoditized nature makes it volatile, and this can be seen in margins as well. After hovering between 17 to 20%, in first half it came at 16.8%, and this is a fall from margin levels of 23% earlier. PAT2 has been very volatile for the company. FY22 was strong, but first half not so much, and hence outlook will be keenly watched on this one.
Okay, all right. So you said that in December, the stock did see some buying. So what's working for the company, and what could the possible risk as well be for the company?
All right, so the company does have more capacity expansions in place, right? That could be a big trigger going forward, along with the focus on custom manufacturing. That is one thing that worked for them. PVC prices, they have been going up. The general idea is that PVC prices have now bottomed out and will only see higher levels from here. So that also bodes well for the company. Additionally, after a few years of pain in the balance sheet, company is now a net cash company. So there has been a decline from levels of 2,100 crore rupees to now net cash levels. In terms of risks, the biggest one being commoditized nature, right? During COVID, there was a massive upside move in PVC prices, and then we saw massive decline as well. So that is something which keeps financials very volatile. So decline in PVC prices could be a risk, and if bigger players come up with more capacity, say Reliance Industries, then it could keep prices under more pressure, and that could be a risk.
Okay, let's round this up then, Sonal. You've given us a fair bit of understanding out there. Couple of things. One, promoter holding, and second, valuations.
All right, so the promoters, that is Sanmar Holdings, they have close to 55% stake in the company. As far as other investors are concerned, some big names. We have Mirae Asset Equity Savings Fund at 8.5%, Axis Mutual Fund Trustee Limited, that is around 3.5%, SBI Long Term Equity Fund, they have a substantial stake at 9.44%. There's Franklin, HDFC Life Insurance Company Limited at around 1.75%. There's Government Pension Global Fund as well at 1.37%. Now, while we have been talking about underperformance as well, that's the reason why the stock trades at reasonable levels at 10 times one-year forward earnings.
Okay, all right. So now, thanks a lot for that. That was an interesting one. Chemplast Sanmar, well, interesting, been a bit of an underperformer, but various triggers lie ahead. But we've completely run out of time on this episode of Inside Out. From Sonal and myself, it's goodbye.
But do write to us and tell us the companies you want us to discuss and you want to hear about. And we'll feature these on our show. Thanks a lot for watching us today.
QCI